New here, my name is Trimble, and I talk about building long-term wealth through passive income. Today, we're going to be talking about these 5 stocks and why I chose them in my portfolio. If you stick around till the end, I'll even share a stock that pays me monthly and is a great deal for any investor. So stick around till the end for that hidden gem. In a world where financial security is becoming more of a dream than a reality, dividend investing emerges as a beacon of hope, especially for all Americans looking for a stable retirement. But what makes dividend stocks such an attractive option? Let's dive in. Warren Buffett said it best with this quote: "Dividend growth occurred every year, just as certain as birthday." Now, in this story, he was talking about Coca-Cola, a beverage that we all enjoy. And why did he choose that company? Well, it's because his company, Berkshire Hathaway, invests in companies with staying power. As an investor, ask yourself this basic question: is this company going away anytime soon? If you're like me, you enjoy the occasional and sometimes too often Coke Zero, or Diet Coke, or even Sprite. I think you see where I'm going. Coke is not going away anytime soon. Coke has a product for every market and every segment and every price point. And that's why Warren Buffett held that stock. It's not going away. Now, let's talk about the power of compounding. And this is what gets me excited and has me picturing the idea of getting away from the 9-to-5 grind and sailing away on a yacht. First and foremost, dividend investing harnesses the power of compounding. If you hold a stock, you've got 3 options. Do you want to hold it? Do you want to sell it? Or do you want to reinvest it? I choose option number 3. Now let me tell you why. Each quarter, 4 times a year, the stocks I'm going to tell you about pay me a dividend or actual money as a shareholder. It's their way of saying thank you for holding our stock and thank you for not selling. Now, some companies pay a high dividend and some pay less. Companies usually pay a high dividend when their share price falls. Let me give you an example. Here's Altria Group. They are a company that have seen their ups and downs like any other company. Their stock is currently hovering around $40 at the time of recording this video. As a shareholder for each stock I own, I will get paid 98 cents a quarter or $3.92 for the year. That's almost $4 for every share of stock. Sometimes the dividend goes up, sometimes it goes down. In this example, I don't care. I get paid regardless as long as I hold the stock. Now, let's say in the story, it's you. You worked hard, you put some money away, and you invested $4,000 in this company. That would be around 100 shares. After a year, Altria Group would pay you 100 times $3.92. And that comes out to $392, almost $400 you didn't have to work for. Now, let's reinvest those dividends. When you reinvest dividends, you're buying more shares without spending any more money, which means more dividends for the future. A cycle that can significantly grow your wealth over time. So if we do the math at today's values, that $392 Altria Group paid me would buy me almost 10 shares. If you're following along, now I have 110 shares. And if Altria Group paid the same thing next year as a shareholder, if I didn't sell any stock, they would pay me $432. This is the power of dividend reinvesting, also known as DRIP. So now I'm on the set it and forget it. And this happens each year. So now you're seeing the point of why this is passive. It's slow and steady income that I don't have to think about in this illustration. So why is this relevant now? That's a good question. I'm glad you asked. If you're like me, you want to swear at a nun when you go grocery shopping, or really shopping for anything. The inflation we're all experiencing is out of this world. They say it's around 3%, but I think we all know they're talking out of their side. If you want to see the real cause of inflation, check out this video that I made right here. Milton Friedman explains it perfectly. Another reason why I like dividends is that because it is an inflation hedge. Dividend paying companies, especially those with a history of increasing their payouts, can offer protection against inflation. As the cost of living rises, so can your income. And if you're like me, you will want to maintain your purchasing power in retirement in 5 years, in 10 years. I don't know about you, but I like the idea of having some guaranteed income in the form of dividends that will pay me and help me keep up with inflation. Warren Buffett, once again, has a timely quote for this video. He says, "If you don't find a way to make money while you sleep, you will work until you die." I don't want to die working, and I'm sure you don't either. Imagine earning money while you sleep. That's the essence of dividend investing. It provides a passive income stream that can fund your lifestyle in early retirement, reducing reliance on Social Security or other retirement savings. And I don't know about you, but I don't have confidence that Social Security is going to be there when I get to be age 62 or 67 or 70. The other issue about Social Security is it going to keep up with inflation? Up to 87% of Americans claim to have lost sleep because of economic anxiety. Commissioned by the American Academy of Sleep Medicine, nearly 20% of the respondents said that they almost always lose sleep over concerns about money. That's a scary idea. So let's mitigate that risk. Diversifying your portfolio with dividend stocks can also reduce risk. Many dividend companies are established, financially stable entities that can weather economic downturns better than non-dividend paying firms. Whether you're in your 20s, your 30s, your 40s, it's never too late or too early to start investing in dividend stocks. I didn't start investing until I was in my 30s. I spent my 20s partying it up, but I realized I had some catching up to do. I didn't start with a lot, believe you me, but I live below my means and was able to sock away a bit here and a bit there. The key is consistency and having a long-term perspective. Starting now can make a significant difference in your financial well-being in retirement. If you want to start after watching this video, I'll leave a link in the description to Robinhood, the app that I use to make my daily investments. It's fast, it's easy, and it takes about 5 minutes to set up. And if you use my link in the description below, you'll get up to $200 in free stocks. The awesome thing about Robinhood is that you can buy fractional shares. So that means you can purchase a stock in smaller increments, $1, $2, $5, $20. You get as much stock as you can afford. That's why I feel dividend investing is open to everyone. That's a bargain if you ask me. Now, let's get into my reasoning for investing in these 5 companies. By focusing on stocks like USAC, SHCD, Microsoft, Waste Management, and Walmart, investors like you can tap into a variety of industries and sectors, further diversifying their income and reducing their risk. Each of these companies has demonstrated a commitment to returning value to shareholders through dividends, making them ideal for a recession-proof retirement and investing strategy. In conclusion, dividend investing is not just a strategy, it's a lifeline for those seeking financial independence and security in their golden years, or who want to have a steady stream of passive income. As we move forward, we'll explore how you can select the right dividend stocks and build a portfolio that aligns with your retirement goals. Will you also be on the boat sailing away with me? Let's get started. Let's kick things off with our first dividend darling, USAC, also known as USA Compression Partners LP. Now, for those of you who are all about diving into the energy sector, especially if you have a keen eye on oil and gas equipment and services, you're going to want to lean in for this. USAC, they're not just another name in the game. They've got this amazing streak, 11 years of consistent dividend payouts. I mean, talk about reliability, right? And with a dividend yield sitting pretty at 8.7%, which is on the high end, and doling out $2.10 a share, USAC is like a beacon for anyone looking into solid income flow in what can often feel like a roller coaster market. So here's the scoop. It has an 8.7% yield. That's like finding a gem in the sea of average, giving you a pretty sweet income stream. These guys are the ones behind the scenes, making sure natural gas gets from point A to point B, serving up essential services to the big players in oil and natural gas. And let's be real, despite all the buzz surrounding electric vehicles, we're still living in a world that runs on oil and gas. Did you know that 60% of US homes rely on natural gas for their daily needs? That's a stat straight from the US Energy Information Administration, a place I didn't even know existed until I started digging into this. And here's why I'm all into USAC. This stock has been on the move, jumping up 26.74% in the last 6 months. And over the past year, up by 15.57% as of the time of this recording. It's showing signs of both growth and resilience, which is exactly what I like to see. It's also got insider confidence. Let me tell you about that. Now this is key. The folks running the show, they own a hefty chunk of the company, 45.7% to be exact. They're not just passing through, they're in it for the long haul, invested in USAC's success. In the grand scheme of things, USA's role in natural gas compression is vital. With the ongoing search for cleaner energy sources, natural gas is in the spotlight, and USAC is there ready to shine. We're talking about a company that offers the best of both worlds, juicy dividends and the potential for stock price appreciation. That's a combo that's hard to ignore, especially in the evolving energy landscape. With a hefty fleet and a focus on crucial areas like gas gathering systems and processing facilities, USAC is smartly placed to make the most of natural gases' role as a transitional fuel to greener pastures. So there you have it. My take on why USAC is a top pick for those looking to dive into dividends, especially within the energy sector. It's not just about the now, it's about tapping into a company that's poised for the future, all while pocketing some nice dividends along the way. Stick around for the next pick. Number 2 is SHCD, Charles Schwab US Dividend Equity ETF. Now, SHCD is one of my favorite ETFs because it has a whole bunch of stock. You see, they've done all the hard work for us, my kind of company. Let me explain. For those new to investing, incorporating a dividend exchange traded fund ETF, such as the Schwab US Dividend Equity ETF, into your portfolio is a strategic move. Dividend ETFs, like SHCD, not only provide a stream of passive income, but also represent investment in profitable, high-quality companies. This ETF offers exposure to 100 leading dividend-paying U.S. stocks, granting instant diversification and income potential at a minimal expense ratio of 0.06%. This feature is beneficial for both novice and seasoned investors looking to broaden their exposure to premier U.S. dividend stocks efficiently. Let me know in the comments below. Do you agree that SHCD is a good investment, or are you holding on to something else? In times of market volatility, dividend stocks have shown resilience, making them a valuable component of a diversified investment strategy. In 2022, while major indices like the S&P 500 and NASDAQ 100 experienced significant downturns, SHCD demonstrated remarkable stability, underlying the defensive nature of dividend-paying stocks. And SHCD has a great history of paying out dividends. They've been increasing their payouts for 10 plus years. I also like it because it invests in companies that you and me both know. Its portfolio features prominent companies like Verizon, Coca-Cola, Pepsi, and Home Depot. These companies, known as dividend kings, have a long history of consistent dividend payouts. With all of these options going for it, this is why SHCD is my number 2 pick. Don't leave yet. Let's talk about my next pick, number 3, Microsoft. Now, what can I say about Microsoft? I've been using their product since I was in the 4th grade, a very long time ago. One of my first operating systems was DOS, short for Disk Operating System. But this is not a video about Microsoft's history. This is about why Microsoft is number 3 on my list. As a titan in the technology sector, Microsoft's growth trajectory continues to impress, and Microsoft has a commitment to returning value to shareholders through dividends. Microsoft is a solid company and it's not going away. It's got a very solid business with diversified income streams spanning from cloud computing, gaming, and their latest achievement, AI. You don't have to take my word on it. Just ask Steve Ballmer, Microsoft's former CEO. He has 1 billion reasons to be a believer in this stock. Ballmer, the 6th richest person in the world, is due to collect that much in dividends from Microsoft in 2024. This comes after the tech giant boosted its quarterly dividend payout to 75 cents a share, $3 a share annually. Since Ballmer, the former CEO of Microsoft, 333.2 million shares of Microsoft as of 2014, he would receive just shy of 1 billion. That's simply for owning the stock, regardless of how it performs. And if you need one more reason to go with Microsoft, let's not forget about Microsoft's recent acquisition of Activision Blizzard, a gaming juggernaut. Owning Xbox and various game developers, including Activision Blizzard, Microsoft leverages its cloud computing capabilities to be a pioneer in cloud gaming computing. So like I've been saying earlier, Microsoft is not going away and is a recession-proof investment. I don't know about you, but my trash service comes every Wednesday morning like clockwork. It's good to be in the waste management business, and waste management is my number 4 pick. Let's see why this garbage company is a solid investment for 2024. Waste management really caught my eye as a standout pick for 2024, and I've got to say, their performance is something to talk about. They finished 2023 on a high note, beating everyone's expectations. And it looks like they're not planning to slow down anytime soon. They're pouring money into their business, which they believe will bring in better profits down the line. And you know what? I think they're onto something there. Now here's something else that impresses me. Waste Management has been paying dividends for nearly 21 years. I know that's older than some of you watching this video. That's right, 21 years. That's a track record that makes me feel pretty confident. With the market cap sitting at 81 billion and their stock price getting a bump recently, it's clear they're doing something right. Even last week, at the time of recording this video, while the rest of the market was taking a dive, Waste Management shares actually jumped up 5.4%. That's a significant move, especially when you compare it to the 1.4% drop in the S&P 500. It tells me that investors have a lot of faith in what Waste Management is doing. And digging into their latest quarterly report, they pulled in a whopping $5.2 billion in revenue, hitting an all-time high and showing a nearly 6% increase from the year before. That's pretty solid, especially considering that waste collection and recycling aren't exactly the most glamorous or high growth industries, but it's the consistency that catches my eye. They're saying, hey, we got this, and they keep proving it quarter after quarter. So why am I so bullish on Waste Management in 2024? They're not just sticking to the status quo, they're actively working to grow and innovate, particularly in their energy projects. They're planning to hike their dividend for the 21st consecutive year come March. That tells me that they're confident in their ongoing revenue growth and their ability to keep boosting profits. For income investors, this kind of consistency and commitment to dividends is like gold. So Waste Management is a compelling stock for anyone looking to add a stable yet forward-thinking company to their portfolio in 2024. All right, folks, before we move on to my 5th and final pick and the monthly bonus pick, you've just heard about the exciting world of Waste Management stocks and the thrilling saga of dividends, investments, and the future of trash. Yes, you heard that right, trash. Now imagine a place where the story comes to life, where finance meets fun and learning about stocks feels more like an adventure than a lecture. Welcome to my YouTube channel. Why hit that subscription button, you ask? Because where else will you get to join in on the journey through the highs and the lows of the stock market with a side of humor that makes even Waste Management sound like the plot of the next blockbuster movie. I dive into topics that might seem mundane or complex and turn them into content that you'll actually want to watch. Think of it as turning the financial news into your favorite sitcom. So what's in it for you? A ticket to a show where learning about investments doesn't put you to sleep, that could make you insights that could make you the most interesting person in the room, and a community that loves to laugh as much as they love to learn. So don't miss out on the content that makes you think, laugh, and maybe even earn a bit. Hit subscribe, join the party, and let's make sense of the dollars and cents together with a few laughs along the way. Trust me, it's the best decision after deciding to invest in trash, of course. See you on the channel. I've saved the best for last. We're talking about pick number 5. Hey folks, today I'm diving into why I think Walmart is such an incredible company to invest in, especially if you're eyeing dividend stocks. And here's the lowdown. Walmart's scale and operational efficiency have driven consistent financial performance and dividend payout. Its ability to thrive and adapt in a changing retail landscape, including e-commerce expansion, underscores its long-term growth. Walmart's role as a consumer staple provider ensures steady demand, making it a reliable dividend stock for investors seeking safety and growth. Walmart has a massive footprint across the US, being the go-to grocery store with a 25% market share. That's huge. It means they're not just selling stuff people want, but stuff people need, and doing it at prices that keeps everyone coming back. This kind of setup, it's what makes Walmart practically recession-proof. Even when the economy is doing somersaults, Walmart stands strong. That's the kind of stability I like in my investments. And here's a bonus. Walmart announced a 3-for-1 stock split recently because it makes shares even more accessible to more people, even their own employees. It's a smart move, making it easier for more folks to get a piece of that big Walmart pie. So you might be wondering, should I jump in now or wait for a dip? Walmart's got a lot going for it, with plans to grow revenue by 6% next year. They're not just sitting pretty, they're pushing into e-commerce, advertising, and making their operations more efficient through automation. All this while planning to boost their profits faster than sales. So there you have it. Walmart's not just a store where you buy groceries, it's a solid investment that's ready to stand the test of time. And the market's up. So if you've got Walmart in your portfolio, you're gonna wanna hold on tight. Since you stuck around to the end, I'm going to give you a bonus pick that pays you monthly. You get paid each month to hold this stock. That's rather nice and generous if you ask me. So let's share it with you. I'm talking about O, which is a REIT, Real Estate Investment Trust. Imagine a company that owns, operates, or finances income-producing real estate. Instead of buying a piece of property directly in a REIT and get a share of the income produced through real estate investment without having to go out and buy or finance any properties yourself. Being a landlord, but without the hassle of fixing leaky faucets at 2 a.m. Plus, REITs by law are required to distribute at least 90% of their taxable income to shareholders in the form of dividends, which is pretty sweet for us dividend hunters. So O isn't just any REIT, it's known as the monthly dividend company. O specializes in commercial real estate, owning over 6,500 properties under long-term net lease agreement. This means that their tenants, who span across industries like retail, healthcare, and convenience stores, are responsible for most of the property expenses. This setup provides O with stable and predictable cash flows, which in turn supports those dependable monthly dividends. Another point in O's favor is its diversification. Their properties are spread across 49 states and the UK, and they have over 600 tenants from 50 different industries. This diversity helps cushion O against economic downturns in any single industry or geographic area. So even when certain sectors face challenges, O's portfolio is designed to weather the storm. So there you have it, my take on Reality Income Corporation, or O. So as always, don't forget to do your own research and consider your investment goals. Catch you in the next video for more insights into making your money work for you.